Hello friends all wherever you are. How's everyone? Welcome back with me here. And on this occasion, I will read the forms of confirmation candlesticks that you must know. Watch this video to the end so you don't fail to understand this explanation. Trading strategy using confirmation candlesticks is one of the most powerful methods used by price action traders. See how to use it in the following video. When you just open a price chart, of course you can't immediately take a sell or buy entry for no reason. It is very reckless for a trader to enter the market without prior analysis. Before entry, you must analyze the chart to draw up a trading plan that suits the trading system you are using. From this trading plan, we have an idea of whether we will enter the market and what kind of entry scenario will be used. In a trading plan, there is something called confirmation. This confirmation will determine whether you will enter the market or not. So what is confirmation? What does confirmation look like? How do I apply it to graphics? What is a candlestick and how to read it? Reporting from Investopedia, candlesticks are one type of price chart in technical analysis that shows the highest price, high, the lowest price, low, the opening price, open price, and the closing price, close price, of an instrument in a certain period. As the name implies, candlesticks are shaped like candles that are often used in technical analysis. How to read candlesticks well? To read candlesticks, we must understand the composition or anatomy of the candlesticks first. One candlestick consists of a candle body, and a tail, shadow. To form the body and shadow, there are four price components that make up the opening price, open price, closing price, close price, the highest price, and the lowest price, lowest price. If the closing price is higher than the opening price, a bullish candlestick is formed, which is usually green. Meanwhile, if the closing price is lower than the opening price, a bearish candlestick is formed, which is usually red. If the closing price is the same as the opening price, a doji candlestick is formed as shown in this picture. Meaning of bullish, bearish and doji candlesticks. Bullish, buyers are dominating and pushing prices higher. Bearish, sellers dominate and push the price down. Doji, there is a balance of power between buyers and sellers so that the price could go up and down but close at the same price as the open. What is a confirmation candle? Confirmation candles are candlestick shapes or patterns which, when formed, make the trading signal valid. If there is a confirmation candle, then the trading plan is eligible for market entry. Thus, the confirmation candlestick is vital because it will determine the entry criteria or not. There are three forms of confirmation candlesticks used by the author, namely the pin bar pattern, the engulfing pattern, and the inside bar pattern. These three candlestick patterns were chosen because of the high probability that the price will reverse if it forms at a strong level. Pin bar candlestick pattern. The pin bar pattern is a single candlestick where the tail, shadow, is much longer than the body of the candle. The pin bar candlestick pattern has two forms, namely a bullish pin bar and a bearish pin bar, as shown in the following picture. A bullish pin bar means that there is pressure from a strong buyer and wants to maintain a certain level. A bullish pin bar pattern that forms at support, demand, or other strong levels indicates that there is a great potential for price strengthening. While a bearish pin bar means that there is strong pressure from sellers who want to maintain that level. A bearish pin bar candlestick pattern that forms at resistance, supply, or other strong levels indicates that there is a great potential for the price to weaken. Engulfing candlestick pattern. An engulfing pattern is two candlesticks where the closing price of the next candlestick covers, engulf, equals, or exceeds the opening price of the previous candlestick. The engulfing candlestick pattern has two forms, namely bullish engulfing and bearish engulfing. Bullish engulfing means that there is strong buyer pressure after a downtrend. A bullish engulfing pattern that forms at a certain support, demand, or strong level indicates that there is a potential for prices to strengthen. On the other hand, bearish engulfing means that there is strong seller pressure after an uptrend. A bearish engulfing pattern that forms at resistance, demand, or other strong levels indicates the potential for prices to weaken. Inside bar candlestick pattern. Inside bar consists of two candlesticks that are inside the range of the first candle, mother bar. This pattern has two types, namely bullish inside bar and bearish inside bar. Unlike the two previous candlestick patterns, the bullish inside bar pattern that is formed at support, demand, or other strong levels is not yet considered valid, indicating a reversal. This pattern is only valid if the price manages to rise until it closes above the mother bar range. How to use confirmation candlesticks in price action. There is a common mistake that novice traders often make in using candlestick patterns for confirmation. As a result, these confirmation patterns fail more often than succeed. The correct process is to look at the condition of the market structure that occurs and then look for a strong level to wait for a confirmation pattern to form. Seeing the condition of the market structure. The first thing you have to do is determine what kind of market structure is going on. You must be able to answer whether the market is trending or sideways/ranging. If your trading strategy is effective in trending market conditions, then don't enter the sideways market, and vice versa. You can look for another pair or wait for the pair to enter a trend condition. Then how to see the market structure. Pay attention to the highest price, high, and the lowest price, low, that is formed. Trending market conditions have the characteristics of lower lows or higher highs, while sideways or ranging are characterized by prices that go up and down within a certain range. Looking for strong levels for reversal area. After the trending conditions are met, we enter into determining the reversal area. You can use support/resistance or supply/demand levels. Mark strong support/resistance or supply/demand levels so that the potential price reversal is even greater. The following is an example of an entry using a confirmation candlestick at strong support and resistance levels in trending market conditions. If the price has not entered at that level, then wait patiently. Waiting in trading is a process you cannot avoid. Entry when a confirmation candlestick pattern is formed at the level. This is the moment you've been waiting for. After the trending conditions and levels are met, now you just have to enter when a confirmation candlestick is formed. By doing the three things above, you are trading correctly, because Number 1. You are supported by the ongoing trend so that the profit opportunity is greater than the loss. Number 2. You enter at a strong level and this adds to the profit opportunity. With entry at a strong level, your risk-reward will be greater. This strategy does not guarantee continuous profit every time you enter, because there is no 100% win rate in trading. However, if you are disciplined and consistent in doing the three things above, then in the long term your trading can be profitable. This long-term mindset must be embedded in the mind of every trader in order to be disciplined in trading. Okay, that's an explanation of the confirmation candlestick form that you must know as a novice trader. Hopefully this video is useful for all of you. See you in the next video. Thank you.